I don't think the first few interest rate increases will have an enormous impact on the structure of lending rates in the market. Now, it depends on how quickly they go up and the psychological impact of that, and of course where they eventually go to. But I don't think that an interest increase in the States tomorrow, which is quite likely, will suddenly bring the economy to a juddering halt. In fact, I think the economy will flow through it quite easily. And financial markets now, I think, are tuned into this, and I think it'll turn out to actually be quite a good thing for financial markets. I think the worst thing is further delay.
There are concerns that perhaps the US economy is not as strong as people had thought it was, and perhaps it's about to be buffeted around by the forces out east. What you've got to remember is the Federal Reserve sets interest rates for the US economy, and the US economy is suggestive of growth, albeit rather tepid growth, but growth and some gradually building inflation, certainly on the wage side, probably enough just about to nudge up rates, as Yellen has said very clearly, if not this month, then certainly before the end of the year.
If you looked at the domestic US economy, particularly the consumer, it's not in bad shape. But the reality is that part of the Fed's mandate is inflation, to keep inflation at a reasonable level. Inflation, particularly core inflation, is well below that level at about 1.2%, or even as low as 0.8% if you exclude housing. So inflation is well below the Fed's target, and everything we're seeing from the international environment suggests that inflation is going to fall further, and certainly expectations are falling, and there's a deflationary pulse coming from elsewhere in the global economy. So it's the fragility of the external environment which we think they'll take into account.